We're talking about the president's tweet directed at the Federal Reserve. And then, of course, last week we had Jerome Powell saying, I'm here for 4 years. I'm going to serve my term. Where is this going to wind up? Does the president gain anything from these tweets?
Yeah, there's so much to unpackage here. It's frustrating because on one hand, the president continues to discuss how strong this economy has been, the records that we're breaking, all the excitement surrounding the economy. On the other hand, he's calling for rate cuts, which usually happen. Usually we're raising rates as the economy is strong, as occurred in 2018. I do think he's right in that the Fed shouldn't have raised rates in December of last year. They are right to look to cut at this point, and I think for insurance purposes. But it isn't because rates are high. I think so much of the weakness that we've seen recently is directly as a result of tariffs. And I'm worried that the tariffs, I guess this is giving President Trump ammunition, leverage at the negotiating table, and that he has the Fed there to back him up when tariffs really start to damage our economy. So I think any weakness he's looking to blame on the Fed and turn it away from the true cause, which I believe is the tariffs.
And it sounds like then you think tariffs are going to continue to be an issue for the economy and for the markets for quite some time. Yet at the same time, you're looking at cyclicals over defensives. If tariffs are going to continue to be an issue, why then go sort of further out the risk curve when it comes to equities?
Yeah, I think cyclical stocks offer, the best value trade-off right now. The defensive sectors have really been, kind of the star of the show recently. We saw them, outperform cyclical stocks towards the end of 2018 as well. And I just think where, being in a low-growth world, the cyclicals are really where investors should, have a focus. And I don't think investors should be considering, a massive overweight to cyclical sectors. We are in the later stages of this economic cycle. Now is not the time to pile in to some of these highly levered companies that are more focused on the cyclical growth story as opposed to the secular growth story. But as far as value is concerned in the market right now, I think technology, discretionary, even the banks and energy are strong value plays compared to some of the defensive sectors that are more rate sensitive.
Yeah, I would absolutely agree with you. I think you're spot on, and I think that the market essentially has told the Fed, well, if you're going to cut in December or at any point this year, why not just do it in July? People seem to be more willing to take that preemptive approach right now.
Timothy, I'm curious about something. You think there's opportunity with the financials, and I'm looking at 52 weeks, and I'm comparing Wells Fargo, Bank of America, JP Morgan, and Citi. And, most of them are down for the last 52 weeks when you compare them to the Dow Jones Industrial Average. Where do you think we're headed with financials, and why do you see opportunity given this interest rate environment?
Yeah, I think financials have really struggled in the last 12 months because of the yield curve flattening. Last year, with the Fed raising rates as many times as they did, the yield curve flattened, it ultimately inverted. And I think with the Fed looking to cut rates and potentially even seeing a 50 basis point rate cut coming in July, we actually could see the yield curve start to steepen a little bit, and that would bode well for the banks. With that being said, a lot of the financials, I think, are just so and I guess rightfully so. Investors are so focused on where rates are, but a lot of these banks have really started to transition away from traditional lending and mortgages, and really started to get more into some of the non-interest income like insurance and wealth management. And so there's a report out last week, that Goldman's really going to be focused on private equity and venture capital and bringing that to more institutional investors. I think this is the right approach because I think low interest rates will stay low for long. It's the banks who are nimble and have revenue coming from non-interest income sources that are really positioned the best, moving forward.
All right, Tim, great to see you. Tim Chubb of Girard. Appreciate it.